So Bitcoin has been stuck in a 100-day long consolidation, and the usual suspects are crying about artificial market manipulation. That's not the case. Let's set the record straight. This is just the same stair-stepping process that we've seen throughout this Bitcoin bull market and bull markets prior. If you take a look at this chart here, you can see long-term holders are just doing what they always do, and that's selling into strength as new market participants step in. You can see Bitcoin ran from 15K to 25K, then 40K to 65K, and now 95K. And you can see I've labeled each of those times there. Where I put the number over long-term holder supply in green, that's when distribution begins, when long-term holders begin selling coins to new entrants and a breakout happens. And then we get consolidation as long-term holders accumulate. And then you can see the number 2. That's where long-term holder distribution began. They began accumulating again after we saw that breakout. And then number 3, they began distributing again, and then we saw another breakout. And right now, the most recent breakout we saw in November was met with, as you guessed it, long-term holders distributing their supply, tens of thousands of Bitcoin worth of sell pressure to new market entrants in order to drive that rally. And now we're in a consolidation phase at the moment. It's the same pattern: accumulation, distribution, consolidation, breakout, rinse and repeat. And right now, in fact, long-term holders have actually flipped back into accumulation. You can see over at the far right side of that chart, that green line is inflecting higher. Historically, this signals the final phase of consolidation before another expansion. Obviously, the timing isn't always precise. You could see last summer, there's quite a bit of long-term holder accumulation that lasted all the way from right around late March to early April, all the way through October, until long-term holders actually really began, until the rally began following this extended period of long-term holder accumulation. So the timing is not always precise, but the setup is very clear. Long-term holders are back as net accumulators, and as supply tightens and demand picks up, Bitcoin eventually makes its next move higher, so long as we are in a bull market. So the first thing I want to talk to you about is right here. This is Bitcoin. Now, of course, Bitcoin finds itself in a relatively similar situation to what it found itself in last summer. We had a descending channel of consolidation last summer, but of course that was much longer. That was 7 to 8 months. This current pattern Bitcoin finds itself in, it's made 2 attempts of breaking out of it, once at the start of the month and once much earlier today, which it likely would have done had it not been for a Bybit hack of $1.4 billion worth of Ethereum that sent the entire market in a tailspin. That was actually the largest hack in the history of crypto, quote unquote, and Bitcoin is only down 1.5% on the day. Just a small side note. And that's a testament to its outright strength and also its waning correlations with all the other garbage in the market. This wedge itself, if you'll go to where it ends, it looks to resolve itself by the first week of March. So if we're looking for a breakout to the upside, it'll probably happen by that point. Otherwise, we fail and we continue trending sideways. So Bitcoin has now been consolidating for about half of the length of time it's been consolidating last summer. It's been consolidating for about 101 days. But one catalyst that could set it off is President Trump's working group, which is set to determine the viability of a strategic Bitcoin reserve well before the end of June. And its findings for that could very well be the next major catalyst for Bitcoin, whether they finalize them at that deadline or well beyond it. Taking a look at spot Bitcoin ETF flows, these have diminished significantly since early January and are now logging 7- and 8-figure inflows on a daily basis, and sometimes veering into net outflows, which is a far cry from the 9- and sometimes 10-figure inflows that we saw during last spring and then in the fall. And so right here, you could see this in the top pane. That's daily Bitcoin ETF flows broken up by issuer in millions of dollars. And in and of themselves right now, spot Bitcoin ETF inflows are far too weak to drive Bitcoin's spot price higher. Taking a look at Bitcoin's correlation to global money supply. Global M2 money supply was a key driver for Bitcoin. Obviously, it had this 10-week correlation. Some people were saying it was rather spurious, but judging by how close they were aligned, that's kind of a false conclusion to arrive at. But you could see that this broke a couple of months ago, right around early January timeframe. Now, there has been a major shift in the direction of global M2 since then. Bitcoin obviously did not follow global M2 to the downside. That was because of a bout of dollar strength. That's why global M2 contracted. Now global M2 is expanding again. And of course, it's as a result of US dollar weakness in recent weeks. And so if Bitcoin is to be the beneficiary of this correlation again, this could be a tailwind for Bitcoin's price in the coming weeks and months that may reignite its momentum. One other indicator is gold. If you take a look at these two, gold has led Bitcoin, albeit to a slightly lesser degree than global M2. If you juxtapose the two against each other and set gold to have a 50-day lead, we can see that the two are similarly correlated. If the trajectory of gold is any indication here, it has been since September 2023, right? But if it's any indication now, then Bitcoin may be finally poised, thanks to this global M2 weakness, and of course what gold is suggesting, to break out of this latest choppy consolidation range and gun for the $120,000 mark. And finally, let's take a look at another topic. It's a little bit more niche. Let's take a look at stablecoins. So stablecoins relative to the world's largest holders of US treasuries, obviously China, chief among them. There is another structural buyer that's entered the market, and that is stablecoins. According to Nick Carter, stablecoin issuers now hold around $200 billion in U.S. treasuries, making them one of the largest new buyers of U.S. debt. If you'll take a look at this chart here, that's roughly $200 billion in U.S. treasuries compared to China at around $759 billion. Obviously, foreign demand for treasuries has been weakening for over a decade. China's in particular just hit their lowest level since 2009. Take a look right here. China has been simultaneously stockpiling gold. Its gold reserves now are at $192.8 billion compared to China's $759 billion in U.S. treasuries. So on top of this, right, we have other nations doing the same. You can see China is there in blue. Japan is in white. Japan, the largest foreign holder, is kept its exposure roughly flat over the last 13 years. And Russia, down there in pink at the very bottom, has reduced its holdings to functionally zero, roughly $42 million in U.S. treasuries, which is total chump change. So buyers that are stepping in now are hedge funds running the basis trade, kind of a slew of European countries here and there, but not nearly to the degree that they were previously. If you actually zoom out and take a look at total U.S. Treasury holdings from all foreign entities, they're still rising. They have been rising over the last 25 years, rather steadily, might I add, but they've been choppy lately, particularly since 2015 when China began divesting. And so it begs the question, who is going to sap up the demand that's no longer present amongst these foreign buyers? And that's stablecoins. So stablecoin issuers are a little bit different in that they don't buy treasuries for geopolitical reasons. They buy them because demand for digital dollars keeps growing, and they need a risk-free reserve asset to back them. And that's what makes them such an important part of the dollar network. David Sachs, a White House and AI crypto czar, has pointed out that stablecoins could actually lower long-term interest rates, and he's right. They're acting like almost a new foreign central bank that's soaking up U.S. Treasury supply and therefore keeping rates in check and reinforcing U.S. dollar dominance. Now, the implications for this are massive. The shift away from China and Japan isn't weakening treasuries, it's just changing who holds them. And because stablecoins are designed to track the dollar, their continued growth strengthens U.S. debt markets at the base layer of global payments. So at the end of the day, guys, Bitcoin's setup in this current moment could not be clearer, right? As I mentioned at the top of the hour, long-term holders are now net accumulators. Global liquidity is rising. Gold is moving first. ETF flows are slowing. But in the background, we have larger, more macro developments like stablecoins reinforcing dollar demand in a way that ultimately supports Bitcoin. And on the policy front, Trump's working group could introduce a new catalyst within months that could very well allow Bitcoin to break out of this pesky range we found ourselves in for 101 days and counting. So that's all for today's video. Thank you so much for watching. I appreciate it. If you enjoyed, make sure to check out Thea. It's the world's simplest Bitcoin self-custody solution. You can scan the QR code on the screen right now to take you to the website so you could check it out. If you've been on the fence about taking your Bitcoin into self-custody, today was the largest crypto hack in history, $1.5 billion worth of Ethereum stolen. You don't want that to happen to you, regardless of how good you think your exchange is. So take your coins into self-custody today. Thea is the easiest way to do it. Check us out at thea.us on iPhone and web. That's all for today. Thank you so much for watching. I will talk to you soon.